A good metaphor for capitalists in society is having parasites in a host body. Another metaphor is when a host develops cancer. In these metaphors, the host is the rest of society. In both cases, the parasites and the cancers are using up resources needed by the host, or society. The host suffers and will eventually die as the parasites and cancers grow, taking an increasing amount of energy and resources away from the host. This is what is happening in capitalist societies. The wealthy continue taking a greater proportion of available income and assets. Resources are hoarded by the few at the expense of the majority. This leaves less for the rest of society to stay healthy. Life expectancy and quality of life in the most capitalist societies have been declining. This is one way the sickness of parasitic or cancerous capitalism materializes in a society. Hosts cannot recover until their parasites are removed or their cancers are treated. Treatments for parasites and cancers produce unpleasant and uncomfortable short-term side effects. Likewise, the treatment for removing capitalists have negative short-term consequences. There is short-term shared discomfort to achieve long-term societal health. This means economic downturns and financial adjustments before society can recover and thrive again. The wealthy will try to inflict pain and generate fear in their host populations to try and keep their positions and assets. There will be short-term negative consequences for the countries undergoing treatment, but the long-term benefits will make this transition worthwhile. Society should welcome the departure and downfall of capitalists, even if the adjustment period is difficult and uncomfortable. Capitalists do not contribute the value they extract, making them a net negative for everyone else. Even when capitalists invest their money and increase the size of the economy, their goal is to capture and extract as much of this growth for their own private gain as possible. Average growth and productivity figures are meaningless if the benefits go to a tiny minority at the top. The wealthy only share what is absolutely necessary to further enrich themselves. They have been successful in capturing most new wealth generated in society. The majority of us do not see the benefits. Wealth taxes will be opposed by the wealthy, obviously, much as abolitionism was opposed by slave owners and republicanism was opposed by monarchs. Ultimately, it is all about power. The wealthy are losing some of their power and will use fear to try and hold onto that power. The fact that wealth taxes will slowly chip away at wealth levels is precisely the point, and by design. Wealthy interests will view them as an existential threat, because they are an existential threat to their excessive way of life. Media owned by wealthy interests will run stories about impending economic disasters from raising taxes on the wealthy. There will be much fear-mongering. There will be hysteria about potential job losses, capital flight, and recessions. Wealthy interests will lobby politicians to further their own interests at the expense of society. They have gotten used to imposing their will on populations and will not give up their privileged positions without a fight. The wealthy will attempt to create an economic crisis to remove the government from power. Depending on the country, they may even influence overseas militaries and intelligence agencies to arrange a coup, occupation, or special military operation to bring back the good old days of wealth extraction. They may assassinate leaders. This has happened to many countries. So any country wishing to cure itself of the disease of capitalism must plan and prepare. The wealthy will use every possible strategy and tactic to get the country to reverse course. However, doing so will only help a tiny minority of wealthy individuals, while the rest of the population continues to be disadvantaged. Raising taxes can cause people to leave the country. There are two associated risks here. The first is capital flight, where money to invest in the economy leaves the country. The second is called brain drain, where skilled and productive citizens leave the country. Different policies are needed to address these two risks. Regarding capital flight, it is important to note that people cannot take fixed sources of wealth with them. For example, the wealthy cannot take raw resources, infrastructure, houses, farms, land, and factories with them. Governments with sovereignty over their currencies can create money to buy these assets as the wealthy leave. The inflation risk from creating this new money must be balanced by higher taxes on the wealthy to remove money from circulation. What results is a transfer of wealth from the rich to the poor, which is the intended goal. However, governments must only create new money in the quantities that it leaves the country. This requires having the data to know these values in real time. So we need preparatory legislation enacted prior to implementing any taxes that could cause capital flight. The legislation must establish national, fiscal, and economic monitoring systems and the capacity to analyze and report on this data in real time. The legislation must also put in place mechanisms for automatically determining how much new money can be created without raising inflation. It must allow for real-time monitoring of prices, capital flows, employment levels, migration numbers, and many other relevant metrics. The government needs to be ready for some capital flight and have the tools in place to address the issue before it becomes a problem. It then needs to enact tax level changes gradually and incrementally to avoid sudden shocks. Once taxes on wealthy capitalists get high enough, some may want to leave the country. This is actually ultimately a good thing because capitalists extract more value from the economy than they give back. They would not have enormous private wealth if this was not the case. Nobody invests to lose more money than they invested. They invest to get more money out of the system than they put into it. The risk is capital flight happening so quickly that it causes an economic crisis. It must be engineered to happen gradually so that government can adjust in stages. When taxes are raised gradually on the wealthy, government policies can mitigate the pain caused by the transition. Keep in mind, the wealthy are still people with social roots that are not easily discarded. Fewer people will ultimately end up leaving than the number that first threatened to leave. Even if some wealthy do leave, this could benefit a country because the income these individuals currently hoard could instead be redistributed to more people. The quality of life for most people would increase. And many wealthy people would actually enjoy living in a well-balanced society where everyone around them is safe and secure and living well. That is, everyone except for the sociopaths. So the sociopaths might be the ones that leave the country, and that might not be so bad. In the short term, there will be negative consequences from causing some wealthy people to leave the country. They will likely have to sell their assets before leaving, which could drive down the demand and cost of these assets. There may be some factory closures and job losses unless the government has adequately prepared for these predictable outcomes. The transition may look like an economic decline in terms of stock prices and asset values, but the amount of farmland, homes, and real infrastructure of the nation will remain unchanged. The speculative value of things will decline, but this does not mean that people's standard of living will decline. Other articles will discuss mitigating solutions in other areas of the economy. For example, one of the most important areas left unaddressed here is people's retirement savings, which are usually tied up in stock markets that will be impacted. So it's important to prepare for this change. Also important are house values, which represent most of the wealth held by people in the middle. Other articles will address this issue as it is more complex than can be explained here quickly. The focus here is on a new approach to income and wealth taxes. The other risk of raising taxes too quickly is a sudden brain drain and a skills depletion that removes valuable expertise, knowledge, and labor from society. Once again, the government must enact preparatory legislation prior to implementing maximum income and wealth taxes. For example, the government must make education and training freely available to all. Then, tax changes must be phased in over a long enough period to train people to replace those that might choose to leave. This will smooth the transition and enable replacing workers as some choose to leave. It is again important to remember that most people would prefer to stay where they grew up, close to their family, friends, and familiar surroundings. People generally stay where they are unless conditions get extremely dire. So as long as the conditions change for the better for most people, this will not cause a brain drain. Changes to tax rates must align with improvements in public services and infrastructure. People need to see tangible benefits of the changing tax structures. The quality of life must stay the same at a minimum or preferably improve for most people. Tax rates must change slowly to avoid a sudden brain drain or capital flight. This allows time for society, government, and the economy to adapt to these changes. Entrepreneurs that found highly successful companies should be able to maintain control of those companies even if they cannot claim the full wealth associated with that control. This requires companies to have voting shares separate from ownership shares. Entrepreneurs could maintain control by retaining at least 51% of the voting shares, but sell off their ownership shares to keep below the maximum wealth limit. This model strikes a balance between enabling entrepreneurs to maintain control of their creations and ensuring maximum wealth levels are not exceeded, even if the enterprise does extraordinarily well and would exceed the wealth limit for an individual that owned it. We do not want to risk the founders of successful companies losing interest before executing their visions. Having government officials take over the control of successful firms will not be good for society. Government employees are risk-averse, bureaucratic, and lack the motivation or even the vision to fulfill the legacy created by an entrepreneur. However, we also want to avoid individual entrepreneurs gaining so much wealth they can unilaterally influence government and public decisions. Having separate voting shares enables founders to retain control over their companies no matter how large they get, while their personal wealth remains within the maximum limit. This protects society from undue influence by wealthy individuals. Since entrepreneurs maintain control over their business decisions, they are free to take risks and run businesses how they wish. Government bureaucrats are meanwhile free from the liability associated with any negative consequences of entrepreneurial decisions. More of the value is shared across society, but control stays with the people who created the enterprise.